So I'd like to ask for your philosophy on how to outperform the index.
It's absolutely possible. Without a question, there's no doubt in my mind it's possible.
We're delving into the world of quantitative finance with Michael Robbins. He is a CIO of Larson Financial and the investment advisor of over $15.5 billion of assets under advisement. He is also a professor of finance at Columbia University. Michael, welcome to the show. Welcome to the David Lynn Report.
Thank you. Very glad to be here.
You have a very interesting background and a very interesting approach to investments. Let's start off with this. How does one in your field generate alpha?
So, alpha might be a misnomer for what I do. I'd love to generate alpha, and we do work on that through models and quantitative analysis. But what we really focus on is efficiency. So, a lot of the viewers may be familiar with Grenold and Kahn's fundamental law of active management. And basically, what it says is that active alpha is based on a few things. There's skill, which is what a lot of people focus on, and that's really hard to have and very expensive to hire people to do. There's efficiency, which is translating your choices into the proper investments, buying and selling them properly in a timely manner, and also market breadth, which is the number of opportunities you have available to you. And that's all related to correlation, because if you have a lot of opportunities and they're all very similar, then you might as well have very few. So even without tremendous access to skill, like you might have at a very expensive hedge fund, you can still greatly improve your efficiency and your access to market. And that's really where we focus, because those are much easier things to do, much more accessible, and probably have a bigger effect. And even if you are good at skill, luck plays a lot to do with it. And you could have really great years and really bad years, even if you're very skillful. So getting the right things right first, and then worrying about the hard things, is really how we spend our time. And getting things right first is a lot harder than it sounds. A lot of people who are self-trained, and almost everything I read on the internet, oversimplifies analysis, and the details are what really matters. When I first started on Wall Street, I was a nuclear physicist, and a lot of us who started in quantitative finance at that time were. And what I was taught at the beginning framed my career, and that was the mechanics of the investment vehicles. So I traded the bond basis. There are a lot of different vehicles and a lot of structured products and a lot of complicated ETFs, where it's actually the structure of the vehicle that matters much more so than predicting the underlying reference rate. So a good example is VXX, which is a tremendously popular ETF and a terrible investment, right? Almost any time frame you pick, VXX will lose money almost exponentially. And the reason why is because it's never been structured to be a long-term investment. It's meant to be invested in during working hours on a single day. And the hedge that happens at night, the true up, is what makes it lose money. So almost invariably, if you hold it overnight, you won't benefit, certainly over many nights. So understanding the structures and arbitraging the structures are a much more reliable way to make money, much more tractable way, and honestly, a way that is good for my stress, because I can be comfortable that I understand a certain process and take advantage of it, while other people are a lot more comfortable with luck and actually thrive on the excitement of trying to predict what's going to happen in the next 30 seconds. But focusing on the mechanics and getting it right is really what we focus on, what the book focuses on, and I think a much better way to approach the market than trying to find alpha.
Okay, so you were a nuclear physicist before you doing what you. That reminds me of. Have you seen that movie Margin Call?
No. Oh,
Jeremy
yeah.
Irons.
Margin call. Yeah.
Margin Call. Jeremy Irons and a few other names. Yeah, there was a scene in the boardroom where I think his name is Peter Sullivan in the movie. He's an analyst. People asked him, "What's your background?" He was a rocket scientist, and they asked him, "What are you doing here?" And he said, "Well, I think to speak freely, the money is a lot better in banking." That reminds me of that scene.
Well, it's exactly right. In fact, in my first job on Wall Street, we employed a scientist from I think the National Geological Survey. They went basically what he did was he found oil, which is a tremendously lucrative job, and he got a job with the broker dealer I worked at, and his purpose there was to write a computer program that did technical analysis because we had some really successful market technicians, mostly in the foreign exchange group. And he confided in me after a couple of months of trying to do it. And he said, this is not at all possible, because what happens is these analysts, they look at all these technical strategies, and there's any number of chart patterns that present themselves at any given time. And their skill is to decide which ones to use, not to find them and say, oh, well, it's a bull flag. No, their skill is to say, well, I have these 18 different chart patterns that match today. Which ones do I act on? And the computer couldn't do that, at least not back then, so long ago. Nowadays, it might be more likely, but it's kind of a theme of a lot of what we do here.
I guess we have to back up a little bit and talk about the strategy at large. What exactly is a quantitative strategy, especially and particularly the one that you employ?
Thank you. Yeah, there's a lot of different ways to do it. There's two ways we do it. One is for the core portfolios, we do a top-down analysis. And what that means is we start with economics and we work our way down to the individual instrument buying and selling decision. So we'll take our capital markets assumptions, which you can get anywhere, right? On the internet, JP Morgan, Goldman Sachs, everyone publishes their capital markets assumptions. And what a lot of people do, a lot of advisors, is they create their own. But I often question why, because all these brilliant people with lots of money and resources are giving them away for free. But what's important to do, I think, is to think about it probabilistically. Right? Don't think of one specific answer. I think the economy is going to increase by a certain percentage this year, but look at the distribution of those estimates from many different economists, and look at different assumptions about where the market's going to be, where the economy is going to be in 1 year, 5 year, 10 years, and use those distributions as inputs into your models. And then another thing that people, I think, do that could be done better is they try to forecast asset classes. Do I think stocks are going to go up? Do I think bonds are going to go up? These asset classes overlap each other. And what you really want for a quantitative analysis is independent factors. You want things that don't have to do with each other. There's no point in predicting things that are very similar. You want to predict things that are very different from each other. And so we use factors. Instead of looking at fixed income, we look at interest rates and credit spreads, right? For instance, a convertible bond can act like equities or it can act like bonds. To use bonds and stocks and convertible bonds and credit, they all interfere with each other in the analysis. Another thing we do is we use Bayesian probability to adjust our forecasts. And so Fisher Black and Bob Litterman did some really great work a long time ago about how to incorporate opinions about forecasts, including probabilities, into the optimization exercise, trying to predict those different asset classes to invest in and those different factors to invest in. And then after we do that, we incorporate tilts. And what tilts are really great at is not only including an opinion, but also in creating different products for clients. Because you don't just want to offer one fund. You want to offer an inflation fund, an ESG fund, a quality fund, all these different products. And incorporating tilts into the analysis allows us to do that not only at the factor level, but at the actual investment level. So if we want to tilt towards, say, quality stocks, we don't just say we want 20% more quality stocks. We have our analysis look at the correlations between the stocks, the risks of the stocks, and pick which ones balance each other the best so that the whole is greater than the sum of the parts. And that's really the magic of optimization, what Harry Markowitz and William Sharpe got the Nobel Prize for, not just picking things, but looking at the interaction between those things. That's what makes it special. And that's what a lot of people avoid. They might build a portfolio saying we want to overweight a certain type of stock and then pick them themselves. And that invalidates the analysis that they made, because they may say we want more stocks and then use ARK as a substitute for the S&P 500. And that's not how the math works, but that's how people apply it. It's very similar to the Fama French factors, right? A lot of people say, oh, these factors work, so I'll just invest in them however I want. But what Fama and French did was very, very specific. They had a ranking, they had a whole process for incorporating those decisions into an outperforming portfolio. You can't just say, I prefer small stocks, so I want to buy small stocks. You have to use their method. It's very precise. So that's one way we do it, the top-down method, starting out with the economy and filtering down to a set of stocks, bonds, and other instruments that build a portfolio that should outperform. Another way to do it refers to the mechanisms and the idiosyncrasies of the individual investments. So for things like bonds, credit, very specific asset classes, you really care more about the individual investments than the market itself, because it's those idiosyncrasies that make all the difference. And you saw it very dramatically with Credit Suisse's AT1 bonds, right? It's a lot of people assume that they were very similar to bonds issued by other entities and that they wouldn't get wiped out unless the equity holders got wiped out. And in fact, they did. And it was right there in the documentation. And if you could have seen that difference, if you would have read the documents and seen there was a difference and you believed that was a possibility, you could have arbitraged that. And that's a bottom-up method, right? By looking at the idiosyncrasies of your market and aggregating it up. What most people do, I think, is making the mistake of trying to do something in between and doing neither well. And I think that's where a lot of analysis falls short.
Yeah, it's interesting you brought up Eugene Fama. I had the pleasure of speaking with Dr. Fama about 2 weeks ago.
Wow.
Yeah, on this show, and I asked him about some of the things you brought up, and I sometimes bring up this conversation with fund managers just to irate them, because Fama thinks that you can't really beat the markets, which invalidates the thesis of a lot of people. You mentioned that, well, you brought up the keyword outperform, and I like to bring up this aspect of investing, which is trying to outperform the index. Of course, if you're a believer of the efficient market hypothesis, you would think that it would be very difficult to do this consistently over a long period of time. So I'd like to ask for your philosophy on how to outperform the index.
It's absolutely possible. Without a question, there's no doubt in my mind it's possible. That's not usually what we try to do here. We're providing products for our clients that are appropriate for them. And sometimes that's more important than beating the market. But when I was an arbitrageur for the first 15 years of my career, we did that every day. There are inefficiencies that a person can exploit. The trick behind exploiting inefficiencies is sometimes you have to wait for them, and your costs are continuous, and sometimes you can't make enough to beat your costs. But there's opportunities all the time, and there's different time periods where different investors are focusing on different things. There's an argument that it's actually easier to beat the market for broad indices than it is for some specific stock choices, because different investors have different focuses. And you might have a pension system that evaluates their portfolio every 3 months or 6 months and makes big changes. And you might have scalpers who make quick changes. I had a good friend who was a so's bandit, which if you're familiar with that, that was a kind of an interesting arbitrage. Back, I think it was in the early 90s, what happened was there were these market makers, human beings, who used the NASDAQ 2 market making system, which is a computer program where they were obligated to make bids and offers on stocks on the NASDAQ. for a certain threshold level of assets. And then they also had a separate computer called the Small Orders Execution System, the SOES. And when the market moved, let's say the market was going down, they'd want to pull their bid because they don't want to pay too much. So of course, they'd pull the bid from their NASDAQ level 2 system because the bid was larger on that system. And then once they hit the button for that, they'd move over and they'd hit the button for the SOES system. So what people like my friends did was they'd key up a trade on the SOES system and they'd watch the NASDAQ system like a hawk. And when the bid dropped out, they'd smack the SOES before the market maker had a chance to pull their bid on the SOES. That's an example of an opportunity that was completely exploitable. And the reason why is because the market maker was prioritizing what he was doing. And at that time, he didn't have the opportunity to do both at the same time.
Is that an example of an inefficient market because the market maker had asymmetric information compared to other people?
Oh, he had the same information. He just didn't have the ability to execute both at the same time. And so he had to choose. He chose the larger bid. The SOES bandit chose the smaller bid and was able to react and arbitrage the time difference between the market maker taking care of the most important thing right first and then the less important thing second. But by scalping that over and over again, the SOES bandits made a lot of money.
Could I make the statement that your strategy is akin to, let's say, factor investing? So you pick the factors, value versus growth, big versus small. You mentioned a few already, and then you decide the instruments to execute on those factors?
Yeah, we do that, but I think there's an important distinction, and it's something a lot of people miss on the internet and in research papers. Those are the famous factors, but there are a lot of factors. And if you focus on the most famous broad ones, you're competing with the whole world. And that's really, really hard. So if you specialize and try to find specific inefficiencies, like with the HC1 bonds, then you have less competition. And you might be able to find something that other people are overlooking or can't afford to focus on. So the SOES bandits focused on the inefficiency that the market makers didn't care as much about the SOES bids as the NASDAQ bids. And we did the same thing when I started trading. I arbitraged the treasury bond basis. And what I was doing was focusing on trades that made me a lot of money, but the other market makers in the business, like Goldman Sachs, JP Morgan, it wasn't enough money for them to bother with. They could have stolen my business from me in a heartbeat, but it wasn't big enough for them to care. So if I made a few $1,000,000 a year, that was great. If they made a few $1,000,000 a day, it's not enough for them to get out of bed, right? So if you find a niche, if you find a factor that other people aren't focusing on or fewer people are focusing on, then that's a huge opportunity. If you focus on the famous factors like size or quality, what are the chances you're going to figure out something that all the big boys haven't? Probably pretty small.
Can you comment on one or two factors that you like to follow?
Well, I think the fixed income markets are full of them, right? There are a lot of idiosyncrasies and structures, and it's pretty easy, I think, to beat an index just by picking structures that you think will work. For instance, if you have a weighted index of bonds, then it overweights issuers who have a lot of debt, which is typically considered bad credit quality, right? So if the index is overweighted bad credit and you just focus on good credit, that's one way to maybe outperform. Looking at the different prepayment rates, the different idiosyncrasies inside the documents is also a good way to outperform. There's a lot of people in finance who just don't do the legwork. They just don't do the research, and they buy, say, a credit spread through an ETF instead of data mining the prospectuses, looking at the call features and all the details. So a very common mistake that a lot of people make is that they buy structured notes that invest in things that are different than they look like on the tin. So what's very common in a structured note is it might be, say, a an option, a buffered option on, say, the S&P 500, and the note is on the S&P 500 without the dividends, but it's free, it's costless. So you might compare that to buying the S&P 500 and an exchange traded option, which will cost you a lot. It'll cost you multiple percentage points. Whereas this note is free. Well, it's costless, but it's not free, because if you look at the structure and you analyze it, you see the mechanics of it and where the money comes from, right? It's those things that make the opportunities. And those are the things that a lot of people don't take the time to focus on.
Okay, and when you construct these models, you mentioned Markowitz, portfolio optimization, for example. What are some of the models the assumptions you build into these models? Do you assume that, like, for example, using the Markowitz theory, that that past data is usually a good predictor of the future, so that you take a look at the stock's past performances, you build a matrix of their returns and risk profile, and then you optimize it that way? Is that something you do?
Well, it's a lot more nuanced than that.
Yeah, for
Sorry.
sure. I'm simplifying
And
it, yes.
You bring up some really important points. One is there's no one solution that fits everybody. And the reason why is because there are problems with the technique, and you have to choose what solutions you're going to use. You can't choose.
I love
them all.
having this discussion, by the way, because I haven't really talked to, in my entire career after school, I have not talked to a single fund manager that uses any of these theories we had to study in school. So this is a lot of fun for me. But please continue.
Well, it's important because it's hard to use. They're really hard to use.
Right.
There's a lot of assumptions that they make that just aren't accurate. They assume well-behaved distributions of returns. A lot of people assume, say, the past predicts the future, things like that. Now, there's solutions for all those things, but you can't apply them all at once. To apply extreme distributions is one way to do it. You can use CVAR optimization or shortfall optimization to try to hedge the chance that the distribution will be not normal. You can use robust optimization to try to mediate the fact that these optimizations are often really squirrely. And if you use data that's slightly different on 2 different days, you get completely different results, right? There's lots of ways that these methods can give you the wrong answer. And there's lots of solutions that have been invented to correct them. But you have to pick and choose them for your specific application. And that's what makes quantitative investing such a great career, because you can't just write a book that tells you exactly how to do it. You've got to tailor it to the situation. And tax efficiency is a great example of that. Right? If you have clients that have to pay taxes, then optimizing your tax slots is very complicated and interesting. And that filters into the optimization decision. Right. So there's lots of great things I teach in class, I talk about in the book, and I apply at work that makes those things you learn in school applicable and better than sticking your finger in the air, which is what a lot of people do. But they are nuanced and full of choices. And it's really fun to understand how those choices have to be applied to different situations.
How does quantitative strategies predict or give you an indication of some micro events? For example, could your strategies have predicted the regional banking crisis and the run on banks that we saw?
That's an interesting example. And I think it might be common in that it's completely predictable. I think a lot of people saw the weaknesses. The trick isn't predicting whether it's going to happen, but when. Right? In every crisis, there are people who see it coming, but they see it coming so far in advance that if they were to act on it, they'd run out of money before it happened. The timing is really important. And the people who don't believe in active management, the people who believe in efficient markets, make the mistake of assuming that just because timing is hard, you can avoid it. Nobody can avoid timing. Every choice involves picking the right time to do it in. And the banking crisis was very much like that, right? The chief problem that created the banking crisis was that banks relied on short-term deposits being sticky and then invested long-term. And to do that, they used a specific accounting rule that was not only allowed, but recommended, that they assumed for accounting purposes that they would hold their assets until maturity. And then when the deposits started to leave, they had to draw on those assets, and the gap between the accounting valuation and the mark-to-market valuation dramatically decreased the value of the bank. Everybody knew that that could happen, just people didn't expect it to happen right then. And you either had to choose to not invest in regional banks at all, which would skew your portfolio dramatically and maybe not in a good way, or you had to wait it out and try to time it. So I think it was predictable, just the way the AT1 bonds were predictable. What was really hard to predict was the timing.
Well, how does one predict timing? I've never encountered anybody that has nailed that.
Well, I think the way to do most of these things is to deal in probabilities, right? And to look at a lot of different possible outcomes and arrange their probabilities in a way that hopefully you make money over time. One of the things I talk about in the book, and I didn't invent it, is to create 4 quadrants. And in those quadrants have different economic conditions that you think might happen in the future. Assign probabilities to those 4 possible futures. And importantly, in each of those boxes, write what would validate, what would confirm that those things are happening, and then also what you would buy and sell under those conditions, and then operate in that framework. And say, for instance, if there's going to be an expansion, I have to see these economic data points. Or if I expect a recession, there'll be these economic data points. And assign a probability to those things. And then watch them and say, oh, these data points are confirmed or they're disconfirmed. And these other ones are starting to be confirmed. And then adjust your probabilities and adjust your hedges and your allocations appropriately. Now, with the banking crisis, it was a little different. What happened there with Silicon Valley and Signature Bank specifically is they had a lot of exposure to specific client groups who are well-informed and tended to act in unison, which is very different from most banks who have clients who don't really think very much about the health of their bank. And they just keep their money in deposits regardless of what's happening in the market. And that exposure to these kind of fast money depositor group was their big risk. A banking analyst, I would hope, would know those things and maybe could predict those things. For a generalist, that's a pretty specific risk factor. But it was very important nonetheless. The same. Sorry.
Oh, sorry. I was going to say, you brought up this quadrant. So let's take that, for example. In your model, which is the economic base case scenario with the highest probability right now?
Well, I think what a lot of people are talking about right now is how the probability of recession seems to be ebbing and waning, right? That's not only a really important risk factor, but it's also highly variable. And it drives a lot of the other factors, like the asset class factors. I read a lot of cross-asset research, cross-asset correlation, and a lot of factors are highly correlated to whether or not there's going to be a recession. And the way to deal with that, I think, is not so much to have a binary portfolio that either makes money if there's a recession or not, but to try to smooth out your opportunity set so you don't lose a lot of money either way. And that can involve buying out of the money options or just buying assets that are resilient in the case of both situations. Here at Larson, what we try to do is we focus on long-term returns, which I think is a lot more lenient in that respect. If you're trying to make money today, then you might not have the ability to buy a portfolio that responds both to an expansion and a contraction.
If I were to say to you, Michael, I'm a hedge fund, and I don't know if there's going to be a recession or not, so I'm just going to hedge both ways. Gold, let's take gold for example. It's traditionally performed at least 0 to positive in all recessions in the past. So I'm going to buy some gold in case there's a recession. I'm also going to buy some Apple call options in case there isn't one. What would you say to me?
Well, the big problem with that, and a lot of hedge funds don't do that for this reason, excuse me, is that options are really expensive, right? Something that most people don't really, it just doesn't sink in, even though it's obvious, is that hedges cost more than they're worth, right? Insurance costs more than it's worth. You buy it because you need it, not because it's a good purchase. So if you're going to lose so much money that your fund will fail, then it might be worth overpaying for that option. But if you are doing it as a trade, you're better self-insuring, right? It's very rare that an option is mispriced. Now, you can arbitrage options. You can find that a certain date is underpriced than another date and then arbitrage it. But you can't perpetually hedge. You have to be smarter than the market. And that's where the efficient market hypothesis has it right. It's not about predicting the market. It's about predicting it differently from everyone else. If you think there's going to be a recession and everybody else thinks there's going to be a recession, you can't make money from that opinion.
So
you can only make money.
I was using call options as an example. I think that you brought up the underlying point, which is predicting the markets. What if I don't want to predict the markets? Can I build a portfolio that will make me money in basically any scenario? So buy some gold, buy some cyclical stocks, just buy a little bit of everything that would play well in every single scenario. Eventually they cancel out. Is that something that even makes sense?
Yeah, well, that's somebody coined a cute phrase, over diversification, right?
Okay.
Where you just hedge everything out. And there was recently a paper about that. I think it was yesterday, maybe the day before, that I saw it. And it was about how a lot of people take their factors, but then bucket their portfolio so they have the same amount of each asset class as their benchmark. And by doing that, they take away most of the benefit of investing in their factors. So if you believe in maybe value, but you make sure you have the same amount of information technology and the same amount of utilities as the S&P 500, you dilute your value factor so much that you lose a lot of the benefit. Now, for a lot of people, that may be the point, that they just don't want to underperform the benchmark and they're trying to track. But you're very right that you have to either be bold in your choices or diluted in your returns. And that's a very important theme of my book and my investing. And it goes back to Grenold and Kahn's fundamental law of active management. You have to be honest about your resources, right? Are you a highly skilled investor? Can you predict the future? Most people can't. They can't even come close. So they try to make sure they hedge their downside and that they track the benchmark, at least to some degree. In that case, it makes sense. But if you're a genius investor, then I think it was Warren Buffett who said, put all your eggs in one basket and watch that basket.
Michael, you were a nuclear physicist. Why not just stay in that field, make a time machine, and that'll be your best investment vehicle?
That's what I would have needed, because they stopped building reactors when I was getting out of university, and there wasn't really much to do there. If I could have created fusion, that would have been a good point, but that's been elusive.
Yeah, well, it's a topic for another time, nuclear fusion. I want to close off on behavioral biases, which is something I believe you also talked about in your book. The importance of removing these biases as a trader. First of all, how do you identify a bias? And I guess the second part of the question is, how do you remove them?
Yeah, that is for all traders a fundamental problem, and all traders know about them. I think one of the really
Do
important
they
things,
know about them? How can you know about your own bias,
well, you
Michael?
know they exist, you know what they are. You just ignore them when you're doing them. And that's one of the problems with biases is that in experiments, even people who are alerted to their biases repeated them. And that's why systematic investing is so helpful because you can weed them out over time. And what's really helpful for them, for systematic investing, for me, is to be able to defend my investment case against my investors and my bosses and say, look, we spend months and months getting these biases out of our investing program. And when the market goes down and everybody gets scared and people question your investment strategy, you can say, look, we studied all this. We've researched this in the past, and this is the bias-free way to address this problem. And just because you're scared, and rightfully so, because the market is crashing or whatever is happening, let's go back to our training, right? Let's do what we studied and committed ourselves to doing to be bias free instead of getting scared and putting everything in question, unless you violate your thesis. And that's another important thing about systematic investing. You define your thesis, you say exactly why you're doing everything you're doing, what your targets are. And you could say, are we doing things that we know we're supposed to do? Are we making less money than we thought we would make, in which case we should continue doing our strategy? Or have we extended ourselves beyond our research, in which case we should shut down our strategy till we're back in our comfort zone? That's the way I try to avoid my biases, to think them out ahead of time and to act on my plan rather than to play it by ear and just react to the situation, which is what a lot of people rely on. Some successfully, but not me.
Can you, let's say you were back at a physics lab and you were to design an experiment, can you apply the same scientific method to testing a hypothesis, to building an investment case? I'll give you some examples of things that I don't think are very scientific. People coming up with a narrative or a conclusion before they looked at any data, and then they just find data to support that particular conclusion while ignoring everything else that may counter that conclusion.
Yeah,
right?
that happens.
Yeah.
Sorry.
How can we design a process that fixes that issue?
Yeah, that happens all the time. And that's really what I wrote the book about, is how to test these theses, right? How to test to see if your idea is correct. The reason why I have to spend so much time writing and teaching about this is that it's really, really difficult to do right. To create a back test involving appropriate costs and slippage and all these other idiosyncrasies, those details make a huge difference, and they're very hard to do well. And so most people who try to test these hypotheses do it incorrectly and either affirm their suspicions incorrectly or just find out that they can't do it because it's too complicated. And that's, I think, the big gap between what professionals do and what you can read on a lot of blogs on the internet, are those nuances that make the hypothesis tests accurate and reproducible. And it's that out of sample result that's so elusive. It's easy to create a back test that justifies your thesis. It's very hard for that back test to continue to perform when you start using real data. And that's the hard part that I work on. But what's really helpful with artificial intelligence and machine learning and all these relatively newer methods is that they address that explicitly, right? There's a lot of talk about overfitting and data mining and explainable AI, where people think about that and address it head on. Whereas with statistics, their heart's in the right place, but it's often very easy to come up with a study that is not measuring what you want to measure. And it takes a real expert statistician with some it has to be someone who really wants to find the right result instead of trying to prove his own thesis to get the right result. It's hard. The same is true with machine learning, but there are a lot more tools that are available to you to do that. And there's a lot written about how to do that right. So it's an active area of research and a very interesting one.
That's my final point, which is how we can integrate AI into your process. This is quantitative finance is not a remarkably new area. It's been development for a number of decades. You brought up some theories from people who have won the Nobel Prize for this field, but the integration of AI could be new. And so my question is how, and what would be the result?
So I think it's very natural, and I incorporate AI into every stage of the investment process. And the reason why it's so easy and natural is AI is really just statistics that have been enhanced. And so a lot of AI strategies fit very well within the common bucket of regression or classification. And anything you can use a standard statistical method on, you might also apply AI to. Now, with all that extra power comes the ability to overfit and to come up with a spurious solution. But you can definitely apply yourself and open up a lot of possibilities and a lot of adaptation to markets on the fly, which is really fun and interesting. And you can come up with a lot of unexpected results that may lead you down a path that you hadn't thought before.
I maybe we can be specific in providing one example because when I think about AI, a lot of people they think let's go on ChatGPT and type in how can I invest during a recession. I've done that before. It's given me some master classes that I've historically done well. I'm guessing that's not what you mean.
No, there are a lot of good examples, and ChatGPT specifically is a terrible example. And the reason why is because it's designed to overfit, right? ChatGPT gives you the answer that it thinks you want to read based on all the other answers that it's found in its research.
So right? ChatGPT doesn't actually understand, quote unquote, understand quantitative finance. It's not producing a result done by its own quantitative research through machine learning. It's just aggregating text that's already been done in that area. Is that right?
And what I tell people is they should write an analysis and then look it up on ChatGPT and subtract out whatever ChatGPT says, because that's the stuff that's not interesting, right? Or maybe wrong. But that doesn't mean AI isn't really, really useful. And it's useful in every step of the situation. It could be useful in predicting economics, in doing the asset allocation, in deciding how different factors are affected by different past results. It's very effective in security selection and very nuanced things. I think a way to really focus on how to use AI is, unlike what people think of ChatGPT, artificial intelligence is very different from human intelligence. It doesn't mean that it's not very useful and smart, but it's different. And so you need to use it in a way that it excels at. So one of the ways it excels is managing enormous amounts of information, being able to research and apply huge data sets that people can't really keep in their minds. So for high frequency traders, they often use very simple rules applied at very short time periods and to large data sets. Things that people are terrible at. They're terrible at thinking quickly with lots of information, right? The same is true with AI. To use many different nuanced examples and apply decisions to vast data sets are effective ways to use AI. To have the computer think like a person and come up with a solution that a really smart person would make is not the right way to use it. So the more nuance, the more fractionated your decision tree is, the more effective your AI can be.
But can a computer design an optimal portfolio based on Markowitz theory, for example?
Well, there are a lot of really interesting ways to apply AI to replace mean variance optimization, to use things like clustering, to find factors that are related to each other, not just at the moment, but on a dynamic basis. So a very well-known common problem with correlations, which is an important input into optimization, is that they're time varying, right? When there's a crisis, correlations often increase, and it doesn't really matter so much what you buy because things all go down together and then return together, right? So applying those time varying clustering of correlations is a way to use AI to make better optimization decisions that are effective based on what you're actually optimizing for, right? So if you perform your optimization in a relatively calm time, but your worry is that we'll have another market crash, you're using the entirely wrong correlations to do your optimization. You're optimizing for the wrong period. So to create, say, an AI method that can optimize for both normal times so that you can make money and crisis times so that you cannot lose a lot of money is a really effective way of using AI to do optimization.
Finally, Michael, where can we learn more about your work? So you have a book. Can you give us, well, we've talked about some of the themes of your book already, but what else can we learn from your book besides what we discussed?
So there's a few themes in the book that we haven't discussed in detail. And one came from the path I took. So I started out as a proprietary trader, which is essentially a professional day trader. And since then, I've worked in a lot of different companies and learned a lot about Wall Street and investing. And a few of those themes that I learned make up the first part of my book. And those are to design products that are appropriate for your audience and for your employer. And that's much more important than I ever thought it was in the first part of my career. Design products that your clients need to buy and that fits in with your business model of your employer, and also how to structure your business. So if you are, say, a day trader who's interested in starting a hedge fund or working for a bank or a prop shop, then that should be really interesting reading for you, how to evolve your career to work in different capacities. Then I go into how to build professional quantitative models, dealing with the idiosyncrasies and the difficulties of managing data that a lot of people gloss over when you read blogs or books. And then how to do artificial intelligence and machine learning in an effective way that doesn't miss out on the nuances of financial markets. And then finally, I talk about how to manage that business. Once you build your models, you start making money, you get funding, how to handle the inevitable hiccups that the market throws your way, and how to manage your business through tough times. And so you can read about that on my book. You can take my course at Columbia, and you can visit my website, quantitativeassetmanagement.com.
How can we get into your class at Columbia? What's the GMAT score I need, Michael?
I'm not so sure about what's involved in matriculation, but I do teach graduate courses at the master's level. So if you awesome. Enroll on a master's degree, or even undergraduates have been taking my course.
Okay, interesting. All right, we'll follow up again next time. Thank you very much for coming on my show today, and we'll speak again soon. Thank you.
Thank you so much. I hope to talk to you soon.
Yes, and thank you for watching. Don't forget to subscribe.